Hello, this is Richard C. Wilson at the Family Office Club. We have with us here today Jim, who's going to be speaking to us about his investment mandate. Welcome, Jim.
Thank you.
So we want to dig in first into your day-to-day role, kind of what type of organization you're with, and what your day-to-day perspective and focus is.
I run a single-family office real estate investment business called Capital Group, based in Chicago. And we buy, simply, we're a real estate investment firm that stays pretty squarely in the real estate space. And we buy really in four real estate food groups in four parts of the U.S. So our business is office investment, industrial investment, residential investment, and retail investment in the Southeast U.S., Southern U.S., Midwest, kind of Chicago. We're in Columbus, where you own something in suburban Chicago, and we keep looking. And then out west, Phoenix and Scottsdale. And, we've looked at Denver, maybe a little overpriced, but, we keep looking. We're kind of short of California and the Northeast, where we have years and years of experience. But we tell people as kinder, gentler Midwesterners, we like 6 and 7% cap rates instead of 4% cap rates.
Great. Okay. Why don't we dig into the retail a little bit, since a lot of people are running away from retail. I would guess you guys are going into stuff with anchor clients where you don't see them going away at all, like a Costco or some sort of service experience type retail. But can you go into that a little bit deeper on what the exact focus is there?
So there's two types of retail. If I was, very good point, Richard, about, when people are running the other way, is there an opportunity? And, anybody who's buying power centers, anybody buying big regional malls, they'll tell you that whatever was a cap rate of a 7% or a 6%, 4 years ago is now a 8% or 9% cap rate.
Mm-hmm.
And there are fortress malls out there. For example, we're buying an investment property in Charlotte, and it's very close to what I call a fortress mall, which is a Simon Mall. It's actually in South Park, which is about 4 miles from downtown Charlotte.
Mm-hmm.
And that mall is probably the most successful regional mall in the U.S., in the southern U.S. It does about $700 in sales per square foot, and every single bay, 1.7 million square feet, is completely full because that's where all the services are in Charlotte. But for the most part, I would tell you that the destination retail I would buy would be strip centers, and we also own about a portfolio of $200 million of grocery. Okay. We like grocery. Obviously, today it's become a little more, a little more hyperbolic about the demand, but for the most part, even with if a grocer's surviving after Whole Foods and Walmart have come into that region, they know what they're doing. So we own actually a bunch of Tom Thumbs, which are Safeway related in the Southeast, down in Dallas. And I think that regionally, where you're buying real estate retail wise, and then the type of retail, destination retail, the drugstore, the dry cleaner, that kind of stuff is probably still very valuable.
Okay.
The other stuff, we're not sure what the impact of the virus and retail in general is going to have on retail right now. And people are frightened. To be honest with you, I think every institutional investor is trying to take stock of, not only if they own hospitality, but if they own retail, what's going to happen to their tenants. They're very worried about that. So, but normally we would look at stuff. It's very hard to aggregate a lot of strip centers. And we've talked to a couple of other families that do this in portfolio. And that's kind of a good investment for us, as well as the grocery.
Sure. Okay. And for those of you who might be listening to this down the road a bit, we're recording this in late March 2020 when the virus crisis has us all locked in our offices, or most likely homes at this point. So what would be the number one type of real estate opportunity you'd look for if the crisis gets extended, into the more painful 3-4 months of mostly lockdown and just economic kind of nuclear winter in that scenario? And then just, if this virus thing had never happened, or once it goes away, what's the number one type of asset that you're looking for in general as kind of your whole thesis for 2020, 2021? Because I know you have these 4 food groups, but I wonder what type is the most appealing type of asset for you to be getting access to.
If I can augment my intro to you, we're middle market investors typically. What that means is in our world, is between $10 million and $75 million in asset size. Okay. Although we'll buy in portfolio as well as we have in the past. The real issue is in that market, it's less efficient. And, given today, there's a huge amount of, the real estate business has been very frothy, right? It's been great for everybody. We're in a 9-year economic expansion until about a month ago. And for the most part, we've been able to take advantage of our real estate acumen, and we find opportunities. We kind of chase yield versus chasing product type, which is what I was going to tell you before. And in the middle market space, you know, the way we look at it is it's too big for the little guy and too small for the big guy.
Sure.
That's why we compete there, because we like to win. And that's been a good, you know, we've gone from 0 to 450 million in 4 years doing that. And, you know, that's onesies and twosies. And then if we could pick off something that was larger in portfolio, we would do it. But to answer your question about growth and what we would be looking at, I think it's unclear at this point yet. You know, everybody talks about a massive repricing of assets. I think it's unclear right now until we know more about the outcome of the coronavirus on what's going to happen to the capital markets.
Right.
Because if there's debt liquidity, there'll be transactions, okay, at some price. And I don't know, you know, and clearly if you have, you know, corporations in your buildings or in your warehouses or in your malls versus having individual people that are home and can't pay the rent. I mean, it just depends on what type of real estate you're buying. And so I think it's kind of early to tell you what we would do now.
Sure.
I think we would look for the same kind of pricing inefficiencies that we look for all the time.
Right.
However, to answer your other question, if I can, about what do we like, we typically do not pioneer. We've been active historically in 10 to 12 U.S. property markets because of our public company background and experience and you know, bringing that to the family office space. So we have an institutional overview.
Okay.
And we don't pioneer. We go into markets where we supplement our information. So for the most part, we're trying to find real estate transactions that fulfill our return and risk requirements. And I think what we do differently than other people may do is that we look at risk a little bit differently. You know, I think I may have told you this, but we try to minimize risk and versus maximize return as a family office. So we're in it for the long haul. You know, we don't have necessarily a barrier on what our timing is, even though we underwrite the 3 to 5 year horizon, investment horizon.
Sure. Right.
But for the most part, you know, it has to do with what type of risk do you want to take? And then the capital that you're playing with, which, you know, again, is our own. The hard part there is, you know, when do you think is a good time to deploy it? And, you know, it's been interesting. Rather than sitting in, you know, 2% money market funds, we've been generating yields between 8% and 15% on the real estate that we're buying. And that's why we're buying. So if we find some inefficiency, if we think a market's rebounding, or we think a piece of real estate is being mispriced, or somebody has a mismatch of assets and liabilities, they need to refinance, or, you know, somebody's got a partner who wants out and needs to liquefy investment. Those are the type of opportunities we try to take advantage of.
Okay. What if we have a family office club member who maybe has an excellent deal, maybe it's retail, strip center, cash flowing well, but they've only closed a few deals. They might have the commercial real estate, you know, special servicer chops or something to really find a good deal, but they struggle with getting the capital to the table. Do you guys ever co-GP or joint venture or work something out so they're still part of the deal and not just paid to go away as a little brokerage fee, but can participate in some way in the upside of that deal with you guys? Or how do you work with other parties?
We do it all the time. We buy real estate directly, or we buy with operating partners.
Sure.
And if somebody can save us time and aggravation by bringing us a transaction that is under control, happy to pay a promote or some kind of incentive fee to somebody.
Okay.
But at the end of the day, they you know, the value that they bring is either on the buy because they're, you know, they can co-invest with us, or they're providing operational value as well.
Sure.
And we have a bunch of partners with us that are limited partners in our that invest side by side with us, but they act kind of as an LP because they're a minority investor. But they're also providing management and leasing. So we have a group in Atlanta, and, you know, they're on an arm's length management and leasing contract because we have to have a right to kick them out if they do something wrong. But at the end of the day, they're investors with us.
Right.
So they want to put their money to work like we want to put our money to work.
Sure.
And they also provide another value to us. So we're happy to have them provide that value as long as, because I will tell you the best part about what we do. I mean, you've heard this before, all real estate is local.
Right.
And the best part about what we do is that we try to find, it'd be great to have a local partner drive by that building every day.
Right.
You know, we're living in Chicago, right? So we're not driving by that building every day.
Right.
So it's great to have somebody who has that alignment of interests. It's terrific.
Sure. Yeah, it makes sense. So one thing we want to do is leave the interview with a big insight for investors listening, maybe a peer, maybe in someone you've worked with before. I know you've been nice enough to speak at one or two of our events in the past. We'll be happy to have you back once we can host live events again. But if somebody like that is listening, what's $100,000 piece of advice that might save them that much in fees or that much in wasted time? In your business, it's relatively easy to save 100,000 if you knew everything you knew 10 years ago or 15 years ago. And so I'd just like you to maybe share, because you might have learned different lessons than a peer your same age, same experience, that they might benefit from an insight you could share here on the interview.
I think the greatest thing about the family office space is relationships, not transactions. So being involved with people that you trust, which takes a long time, that's a relative, that's a relative term.
Right.
And I think the one thing that we learned about the business as we entered the business, a while ago, was that it is built on relationships and not on transactions. So the advice I would give somebody would be, look, if you're working with people that know what they're doing, and you can get, not only you trust them, but also that they're good, real estate investors, or they're good real estate owners and operators, then I think they'll know how to be efficient with your money as well as efficient with their own money. So the best. So I don't have a panacea for you or some magic silver bullet that will, create some immediate gain. But I think the best thing to do is, we optimize. I think the only thing I can share with you is your time's very valuable. And, I think our time is relatively valuable. So if you can optimize your execution of a real estate transaction, which is frankly why we're in the space that we're in, because we can get to the finish line. So being partnered with somebody who knows what they're doing, and, asking the right questions, and being, trying to figure out if, that they've done this before, or they have relative experience, or they see something in the business plan. A great question people should ask is, why are we going to make money with you versus making money with somebody else? And I think that's a great question, because every time you invest in a piece of real estate, you need to have a business plan. And whether you execute it exactly like you wrote it up to be executed, which is rare, or you execute it around similarly to what you had written out, which is usual. At the end of the day, that should be the kind of the question and answer. You just can't, give. I think the best advice is kind of like, you just can't give somebody your money and hope for the best. You gotta kind of ask, you gotta ask the questions you would ask in your own business.
Right. Makes sense. Great. Yeah, no, thanks for sharing that. And hopefully we'll be resuming in May or June. We'll see what happens. But my team will be in touch about, speaking opportunities live in person, so some of our members can meet you face to face and start building that trust. Obviously it's a lot easier when we can all meet face to face rather than digital. But I appreciate you taking the time, out of your schedule to do this recording and share your mandate with our club members.
Thank you very much for having me. I very much appreciate it.
Yep. Thanks, Jim.
Thank you. Thanks, Richard.